Today's bull session concerns startup cap table basics. Hello, friends. This is the advocate Sanjay Arora. Thanks for tuning in. I welcome all of you to my YouTube channel, Legally Determined. Reviewing these startups cap table is one of the first tasks investors perform when starting due diligence on the startup. A capitalization table or cap table is a document, usually an Excel spreadsheet, that tells startup ownership structure and provide formulas to calculate the impact of funding decisions. For instance, the founders track whether investors have preferred share rights such as liquidation preferences. A liquidation preference is a clause in a preferred stock agreement that dictates how company proceeds are distributed to shareholders during a sale, merger, or liquidation. It protects investors by ensuring they receive a specified amount, usually their initial investment or a multiple of it, before common shareholders like founders and employees receive any returns from the company's assets or track the impact of employee stock option vesting schedules. Founders maintain a cap table as they grow and raise money for the startup. The cap table answers: first, how much equity does each founder own? Second, how much money has been invested in the company over time? Third, who owns common shares, preferred shares? Fourth, who are the major employees, stock option holders in the startup? Fifth, what is the valuation of the startup at each funding stage? Sixth, the impact of advanced investment structures such as convertible debt, investments, and warrants. In a convertible debt, the investor makes a loan, namely the debt, to the startup, and that loan converts into equity at some point in the future with an extra bonus to the investor for taking on higher risk of the early stage startup. Warrants are investment structure that entices early investors to support the startup, giving the warrant holder, the investor, the option to buy the company stock at a certain price over a certain time frame. Warrants are typically an add-on to an investment deal. If the startup does really well, the warrant holder, the investor, can buy more stocks called exercising the warrants, thus increasing the holder's stake, the investors in the startup. If the startup fails to increase its value, the warrant holder, the investor, likely will not exercise the warrants. Seventh, equity or stock options granted to major service providers such as software developers, marketing agencies, or law firms. Eighth, what if scenarios for each funding round. Ninth, exit scenario planning. How much money each stakeholder will make if the founders sell the startup. 10th, has there been any down rounds or bridge funding rounds? A down round is a fundraising event where a startup sells new shares at a lower valuation than its previous funding round. A bridge funding round is a temporary infusion of capital that a startup raises to bridge the financial gap between major funding rounds. This interim financing provides startups with the cash runway needed to cover operations, reach key growth milestones, and extend their financial stability until they secure a more substantial equity funding round, an acquisition, or an initial public offering (IPO). An IPO is when a private company sells shares to the public for the first time to raise capital. When does a startup need a cap table? First, the startup equity split between two or more co founders. Second, raise amounts, pre money valuation targets. Pre money valuation is the valuation of the startup before investments. Third, when a startup holds talks with angel investors and venture capitalists. Angel investors are high net worth individuals that invest their own money in startups or early stage ventures, either independently or in organized angel groups. Investing at such an early stage is dicey. So, seasoned angel investors make lots of small investments in startups, building a portfolio of 20 or more companies. If one or two startups go places, the angels get the returns they are looking for. Venture capitalists, VCs, are large investment funds seeking out high growth startups that have proven high end technology and new markets. Venture capitalists are investing other people's money from sources such as private foundations, pension plans, university capital funds, and so on. Venture capitalists exert more control over a startup, such as installing an experienced CEO and requiring a board of directors seat. Fourth, getting early funding for convertible debt. Many early stage startups get their first funding round. Fifth, exit scenarios and other what ifs. Sixth, setting up ESOPs, employees stock option plans. Most startups lack the cash reserves needed to pay talented employees market salary rates. Startups in this situation use stock options to offer key employees and seasoned management members. Stock options give the employees a chance to share in the windfall from a successful exit. Seventh, crucial for understanding ownership structure during M&A events, merger and acquisition. Key sections in the cap table. First, shareholders. Each stakeholders in the startup founders, investors, and option holders. Number of shares owned and the resulting ownership percentage of each investor. Second, stock type. The class of stock held by each shareholder. Common shares, the most basic form of ownership. Stock options issued to key employees are options for common shares, not preferred shares. Preferred shares, angel investors and venture capitalists usually get preferred shares when they invest in a startup. Preferred means that they get certain rights with their shares, such as participation preferences. In the event of an exit, preferred holders participates with the common shareholders to split up the proceeds of the acquisition after any liquidation preferences have been fulfilled. Anti-dilution preference protect the investors against down round. When the pie is getting smaller, investors seek to maintain their current percentage ownership using anti-dilution preferences. Voting rights. Only common shareholders vote on key issues of these startups. Angel investors exert this influence. Preferred shares voting rights clauses include specifics such as having the right to vote with common shareholders on issues such as changes to the articles of incorporation, changes to the corporate bylaws, changes to the size of the board of directors, employee salary levels, including founder salaries, raising additional capital or debt, liquidation or dissolution of the corporation. Third, founders round. Startup formation information is referred to as the founders round. Shares issued to the founders. Each founder's equity split percentage. Stock option pool shares and percentage. Fourth, first angel round. As each new investment round is completed, the startup would add a new set of columns to detail the round, the second angel round section. Fifth, investment round. Deal parameters. For instance, pre-money valuation is 10 lakhs dollar plus investment amount 2 lakh dollars. The 12 lakh dollar is post-money valuation. Sixth, angel round shares and ownership percentage. The number of shares issued to the investor is calculated by the cap table formulas. A cap table formula refers to the various calculations used within a capitalization table, also known as cap table. A spreadsheet or chart that details a company's equity ownership, including who owns which shares and their percentage stake. Some essential calculations are percentage ownership, number of shares owned by shareholder divided by total number of outstanding shares into 100%. Share value, share price multiplied by a number of shares owned. Post money valuation, pre money valuation plus investment amount. Investor ownership in a round. Investor investment divided by post money valuation. Fully diluted shares outstanding. The term fully diluted refers to the process of sizing up the total number of shares that have been issued or promised to the various stakeholders of the startup. The process for calculating the number of fully diluted shares outstanding. First, account for all common shares issued to founders and other stakeholders. Second, convert all preferred shares to common shares. Usually, preferred shares convert on a one-to-one basis, 1:1 basis, but anti-dilution provisions could change this 2:1 2:1 or other ratios as dictated by the anti-dilution provisions outlined in the term sheet. A term sheet is a summary of key terms for an investment or business deal typically used in venture capital funding for startups. It serves as a blueprint for a potential partnership outlining crucial financial and control aspects between a startup and investors, such as company valuation, investment amount, equity stakes, and governance rights. While generally non binding, it provides a foundation for drafting detailed legal agreements, clarifying expectations, and minimizing misunderstandings before formal contracts are created. Third, convert all issued stock options to their common share equivalent. Fourth, account for stock options reserved for future grant. Fifth, convert all warrants to their common share basis. How to calculate an individual shareholder's equity ownership percentage. Divide the number of shares held by the shareholder by the fully diluted number. For instance, there are 10 million fully diluted shares outstanding for your startup. Investor A owns 2 million shares. 2 million divided by 10 million. The result is zero point 0.2 or 20% ownership in the startup. Seventh, the stock option pool details for the startup. Eighth, exit scenario calculations, also known as projected ROI, return on investment on exit. In this section, you can examine what if scenarios by inputting possible exit valuations at the top of the column. The calculations demonstrate how the exit proceeds are divided between each shareholder and the return on investment ROI multiple for outside investors. Key inputs in the cap table for the startup. First, establish the number of authorized shares at the formation stage of a startup. The authorized shares pool is the total number of shares available to issue to the various stakeholders in the company. The share figures you see in the cap table are issued shares deducted from the authorized pool. The number of authorized shares can be augmented by amending the articles of incorporation. Two goals have to be factored into with respect to the number of authorized shares. A. To cover early needs to reflect the founder's shares, stock option pools for employees and other stakeholders. Early investors, such as angels or friends and family investors, setting the authorized share pool too low results in issuing fractional shares. For instance, stockholders owning 57 and one third shares of stock, we should not be touched with the bar score, making equity tracking and calculations cumbersome. Issue a large number of shares in the six digit range at a lower price per share. For instance, 573,333 shares instead of 57 and one third shares. Thanks for watching this vid. Break a leg. Please like, share, comment, and subscribe to my YouTube channel